Have you heard about the super bubble in stocks? Last year, one of the most famous investors warned,
History says that when you reach this level of craziness, the market tends to break.
market crashes happen occasionally and it's not fun. But the stock market is up this year, so now stocks aren't much cheaper than they were last year when everyone was worried about a crash. I'm Nir Kesar, and I'm trying to tackle the biggest questions in markets. Here's the big question I want to answer today. Is the US stock market expensive, or does it only seem that way because a few big companies are pulling it higher? To answer that question, we need to talk about price to earnings ratios. When investors buy a stock, what they're really buying is a piece of a company's earnings. One way to measure how much they're paying is to compare a company's stock price with its earnings. The higher the price to earnings, or PE ratio, the more investors are paying for those earnings. We can also calculate a PE ratio for the market by aggregating the ratios of individual stocks. At the end of 2022, the S&P 500 traded at a forward price earnings ratio of 23 based on expected earnings for the fiscal year, which is modestly higher than the average forward PE ratio back to 1990 when the data series begins. Now the S&P 500 is meaningfully more expensive, trading at closer to 28 times earnings, which was only higher during the dot-com era and again earlier this decade. So there's a separate question here about why we should care about whether stocks are expensive or cheap. And the answer is that historically, when stocks are expensive, it usually means that the returns from stocks going forward are not going to be great. In other words, there's an inverse relationship between how expensive stocks are and the returns that investors are going to get in the future. So that when stocks are expensive, the returns are low, and when stocks are cheap, the returns are high. So anytime you see a market that's expensive, like the one we have here, you should be prepared for lower returns going forward. But not all stocks in the S&P 500 are equally represented. The index's components are weighted by their market value, which favors the biggest companies. The Magnificent Seven, which are Apple, Microsoft, Alphabet, Amazon, Nvidia, Tesla, and Meta, have swelled relative to the field in recent years. They now account for nearly 30% of the index. They have also been among the big winners this year. Nvidia and Meta are the best performing stocks in the S&P 500 this year. The Magnificent Seven have rarely been cheap, but this year's rally has pushed them to rarefied levels. They have an average PE ratio of 43, almost double the average ratio of 25 for the rest of the field. That spread between the average PE ratio of the 7 biggest companies in the S&P 500 and that of the rest of the field has rarely been this wide. It stands to reason then that the market is cheaper when the Magnificent Seven are excluded, and it is, but not as cheap as you might think. For light comparison, I calculated a weighted average PE ratio for the S&P 500, including and excluding the biggest 7 stocks by market value for every year back to 1990. The numbers confirm that when the Magnificent Seven are excluded, the index's current PE ratio falls to 24 from 28. But a PE ratio of 24 is no bargain either. It's higher than the historical average and among the highest PE ratios on record for that group. Even without the Magnificent Seven, the technology sector trades at an average PE ratio of 35, and 7 of the 11 S&P 500 sectors boast an average PE ratio greater than 20. More often than not, the way that gets corrected, or the way the PE ratio goes down, is prices go down. And the higher the PE ratio, the more prices have to go down to bring it back to a reasonable level. Perhaps more important to some investors, the yield on 3-month Treasury bills now exceeds the earnings yield for the S&P 500 minus the top 7 by close to 1.2 percentage points. In other words, some investors might think to themselves, why buy stocks when T-bills appear to pay more? It's the first time the yield on T-bills exceeded the group's earnings yield since 2000, and the third highest spread favoring T-bills on record. That doesn't mean T-bills will outperform stocks. Over the long term, they almost certainly will not. But some investors will prefer to hold cash until short-term interest rates or stock valuations decline, which may help explain the big flows to money market funds this year. And if enough investors choose cash, watch out for falling stock valuations. So yes, the biggest companies are expensive and they're pulling up the valuation of broad market gauges like the S&P 500. But the rest of the field is plenty pricey, and there's no way to pin that on the Magnificent Seven.